Hey everyone, today we're going to discuss about the stock and the stock market. Take note that this video is only meant to make you familiar about the concept of stocks. It will not teach you on how to invest to stocks. So stocks are shares of ownership in a corporation. A person who owns part of the stocks of a company is a shareholder or a stockholder. So this means that if you buy stocks from a company, it means that you are part owner of that company. So there are two ways on how we earn money through stocks. The first is by capital or price appreciation, and second by dividends. Now, the capital or price appreciation is the increase in the market price of your stock over time due to increase in potential value and demand to buy its shares. The reason why there's a price increase because the faster a company grows, the faster a price can appreciate. So basically, what people can do about their stocks is that sometimes they would buy the, the the stocks at a low price and then they sell it at a high price. That's how they earn money from buying and selling stocks. The second is through dividends. Dividends are earnings issued by profitable corporations in cash or in additional stocks as a means for shareholders to share in their distributed profits. So stocks would also earn dividends. Now, there are two kinds of stocks. The common stocks, they represent ownership of the company. It is the ordinary stock of a corporation paying no specified rate or amount of dividend. While the second one is the preferred stocks. These are stocks where stockholders get first choice in distributed profits. Now, if you want to buy stocks, you can buy stocks at the stock market. And it is a place where stocks are being bought and sold. So we can see there from the stock market is the stock market index. It is the measure of the value of a section of a stock market and is computed from the price of selected stocks. This is used to describe the market and compare the return on specific investment. Now, in the stock market, we can ensure that the price of the stocks is not overvalued, not undervalued as well. We have this theory which we call the theory of efficient market. This states that the price of a stock is the accurate reflection of the investor's knowledge about the stock. The market reacts very fast to any information in a given period. The market contains the total views of all the investors in the market. Thus, no stock is undervalued or overvalued. This points out that according to the theory of efficient market, whatever the price of the stock is written there, it means that that represents the accurate information that all the investors know about this particular stock. So we can assure that there's no overvalued or undervalued stock price there. So let us illustrate how shares works with an example. Let's have this example here. A company has 5 million shares. If I own 20,000 shares, what's the percentage of my ownership? So in order for us to determine the percentage of my ownership in the company, we will divide the number of shares that I own with the total number of shares. Remember that I own 20,000. So in our example, 20,000 is there are 20,000 shares, and there's a total of 5 million shares or stocks. So if we divide that, we would get 0.004, or this means 0.4%. So a person who has 20,000 stocks over 5 million stocks would own 0.4% of the company. So if you have more if you own more stocks, then it means you have a higher percentage of owning the company. So higher percentage, yeah. So that's for the stocks. For the next video, we're going to discuss about the bond and the bond market. I hope you guys learned a lot today, and see you guys in the next video.